Hi, and welcome to the second quarter 2019 market update. My name is Doug Johnson. I'm the Senior Investment Strategist here at HCM, and today we wanted to take the time to uh, give you our thoughts on the market for the second quarter, along with providing the announcement that we have made the decision to move our equity targets back to neutral weightings. So in the past, we've done those as kind of two separate webinars, but we think that there's a lot of overlap in terms of rationale and information. So we found it best to go ahead and to combine these into one webinar. So for those who are a little bit short on time, what we will do is use the first two slides to give a very high-level overview of the information that we're going to present today. And then after that, we will provide more detail and some charts to give you a better idea of how we're thinking about the markets going forward. So with that, let's go ahead and take a look at the first slide here that gives our summary on both stocks and bonds. So as I mentioned earlier, we have increased equities back to neutral targets. We believe that the global central banks have pivoted their policy and guided for more accommodation going forward, and we expect this to be at least supportive of risk assets. So we'll go into kind of the thinking behind that in more detail later, but for now, that's going to kind of be the main point that we're focusing on in terms of moving equity risk back to neutral. So when we think about fundamentals, earnings growth is expected to be negative for the first quarter, with slightly higher projections for Q2 and Q3. Slightly higher meaning low single digits. Valuations remain slightly elevated, but they're certainly off the highs that we've seen in 2018. And global growth, for the most part, has begun to slow down. So on the fundamental side of things, we wouldn't say things are great necessarily, but they're probably not to the point where we're staring a recession right in the face. On the fixed income side, we've also made the move to go ahead and begin to let duration increase as both inflation and rate hike forecasts have been reduced. Just as a reminder, duration is a fancy way of describing the relationship between interest rates and price movements for fixed income instruments. So for instance, if you have a bond or a bond portfolio with a duration of 5, if rates move up 1%, then the price of that portfolio is going to go down by 5% roughly. So go back to last year, the Fed guided for 2 or 3 rate hikes through the end of the year in 2018, and then a possibility for up to 3 or 4 more in 2019. So with that forecast, we had reduced duration in our portfolios with the concern that rising rates were going to cause some price volatility in the fixed income area. And for most of 2018, we saw that. At the end of the year, when market volatility picked up, rates started to move down, and then with the Fed kind of backing off their rate hike projections, that was really all we needed to say. Rates probably aren't going any higher from here, and duration can actually help us a little bit if equity volatility picks back up. So we've made the move to start increasing duration in portfolios, and that'll be kind of an ongoing process. The core allocations for our fixed income has increased, while our spread and strategic holdings have been reduced, and we see high yield bonds as expensive historically. So all of the kind of peripheral fixed income assets that we would consider high yield, floating rate, emerging market debt, we think those are a little bit expensive right now. So we've taken the opportunity to go ahead and increase the core holdings in our portfolios. On the economic front, global growth forecasts remain weak. The U.S.-China trade talks seem to be progressing, but the actual deal still remains elusive. There's been a lot of talks about progress being made, 90% of the deal being complete, but that 10% that most likely includes IP theft, which seems to be one of the main issues here. If that's not included in the final deal, then it's kind of a non-starter. So those talks seem to be moving forward, but again, no deal quite yet. And inflation expectations have moved slightly below the Fed's 2% target, or right around there. So as we talked a lot about inflation last year and the possibility of rates moving higher, we don't see any signs of inflation getting to the point where the Fed may need to raise rates again. Now, the situation with the Fed and rates has certainly been dynamic, and there's been a lot of flip-flopping. But for the time being, we're of the opinion that inflation is going to be held in check. Therefore, rates will probably stay in check as well. So what are the risks that we see going into the next quarter? Obviously, we mentioned first quarter earnings reports guided to be negative, but if they come in even weaker than expected, that could cause some market volatility. But if we see belief begin to wane in the ability of central banks to support risk assets, a big driver for the rally that we've seen since December has been kind of a jawboning, so to speak, and a reverse in policy of not just the Fed, but global central banks in general. For the past decade, that's been really good for risk assets when they have been accommodative in terms of their monetary policy. If that kind of psychological barrier breaks down, will the fundamentals be strong enough to, at a minimum, support where prices are right now? So for the time being, we think investors are happy with where the Fed's at and the other central banks. If that confidence shakes a little bit, that could be a problem. If the trade negotiations completely fall apart, which doesn't seem to be happening right now, but if that 90% that they've already claimed to have negotiated, if that falls out, then that could definitely cause a problem. Then lastly, you may have heard a little bit about the yield curve inversion that took place a few weeks ago between the 3-month Treasury rate and the 10-year Treasury rate. Historically, that's been a precursor for a recession, though the timing of that has been somewhat inaccurate. But if that does, in fact, lead to recessionary conditions, that will certainly be a major headwind for the market. So that's kind of our general overview of what we see right now. So if you just want the executive summary, you can go ahead and close the webinar down and move on. If you'd like to hear a little bit more detail, the next 6 or 7 slides, we'll certainly go over that. So we talked about first quarter earnings, and you can get a good sense of kind of the negativity that's surrounding what is expected. This chart shows a breakdown of positive and negative guidance for S&P 500 companies, with the red bars representing negative guidance and the green bars representing positive guidance. So if you look at this, you can tell that there's not a lot of optimism built in to the numbers that are about to be reported starting tomorrow, April 12th. So there's 2 ways to look at this. The first would be, okay, we've had 6 quarters of double-digit earnings growth, which has been very good, and now we're about to go into a quarter with possibly negative earnings growth. How is the market going to react to that? On the flip side of that, we can look at it and say, have expectations been lowered too far? If we put the bar on the floor, it's pretty easy to step over it. And Wall Street does a very good job playing this game where analysts start earnings expectations very high, and then they slowly revise them lower, and then all of a sudden you have a company that reports and they've magically beat earnings. But if we were referencing the initial analyst expectations for earnings, it would not be a beat. So I think there is some psychology that goes on in this. Nonetheless, we do expect earnings in the first quarter to be somewhat poor, but if they are not as poor as expected, that could be a catalyst for a move higher in markets. This chart represents a gauge called the CFNAI, which comes out or is published by the Chicago Fed. And what it is, it's a weighted average of about 85 existing monthly indicators of national economic activity. What the score represents is a growth rate relative to a trend. So if you see positive readings on this, it would indicate that the economic growth in the U.S. is moving above trend and vice versa. So negative would indicate below trend. So this is one of the more popular indicators of a recession. And when we look at this, there's also two horizontal dotted lines there, one representing plus 0.2 and one representing negative 0.7. So anything above the 0.2 line is considered not only growth above trend, but growth with the possibility of generating some inflation. That blue line has dropped below that 0.2, going back to, I'd say, beginning of 2018. At the same time, anything below 0.7 is usually indicated as recessionary growth. And you can see the vertical gray bars there have represented U.S. recessions going back to about 1969. So what we see here is we see a pattern of slowing growth, but growth that is not anywhere near recession levels quite yet. Now, that can change quickly, but when we think about the market outcomes that scare us the most, being large bear markets, those are usually accompanied by recessions. So based on economic growth, we're not quite seeing recessionary indicators raising red flags quite yet. Globally, the story I think is the same. The IMF recently cut its outlook for 2019 global growth to 3.3%. That is the lowest growth forecast since the financial crisis, which you can see is the only one of those that's below the zero line. So again, 3.3% growth isn't terrible, but the reduction in growth forecasts would validate the idea that the global growth is slowing, and it's certainly something to keep an eye on. Now, as we've gone through these slides, some of you may be asking, okay, at the beginning of the webinar, you mentioned that you're moving equity risk back to neutral, but we've kind of taken 3 slides to talk about fundamentals and maybe taken a more negative tone towards those. So if the fundamentals are poor, so to speak, why are markets performing so well? Well, if you take a look at this chart, this is the S&P 500 ETF going back approximately 6 months. So we've annotated this chart because we feel like there's 4 very important parts on this that will explain not only a lot of what's happened, but also kind of what has driven our shift in positioning, so to speak. If you go back to December 18th, the Fed raises rates by 25 basis points and guides for 2 more hikes in 2019. And you can see the market did not like that. Continued to go down to about 2350-ish on the S&P 500 and showed a sharp reversal right around December 26th. So January 4th, so the Fed becomes patient on alert for signs of economic weakness. So that subtle change in language was enough for the market to feel like the Fed was now kind of reassessing their policy of not only reducing their balance sheet on what they called autopilot, but also looking at maybe slowing the pace of rate hikes going forward. So it was a small acknowledgement that the Fed was concerned about what was going on. And if there was going to be a change in policy from the fact that the Fed had been raising rates and was forecasting to raise rates into a slowing economy, which spooked the market, the reversal of that might be enough to see markets recover, so to speak. So January 4th, that was the initial kind of Fed announcement, which was obviously received very well by investors. But that alone, we weren't sure was enough to feel comfortable about Fed guidance. So then we go to January 30th, and we get guidance on rate hike switches to further gradual increases. So now you're getting more language around the fact that they may actually stop the process of raising rates. Again, markets like this, they continue to grind higher. So now we fast forward to March 20th, which was the most recent Fed meeting. And what we saw was the Fed guys to no more rate hikes in 2019, one more in 2020, and then they plan to end balance sheet runoff by September 2019. So this was a significant pivot in terms of policy. Before, in January, they'd hinted at changing, but they hadn't really announced it. This kind of said, hey, we understand that the economy's slowing. We're backing off our plan to raise rates into that environment. And we're also going to stop tightening the balance sheet by letting Treasury bonds and mortgage-backed securities run off. So this was a significant change in policy, and one which for us kind of signaled, okay, the central banks now are back in a very accommodative mode, and we think that that at least takes the worst-case scenario off the table for markets, which would be maybe a retest of the lows that we saw in December or going through those, basically a bear market environment. Now, will this be enough to drive markets higher? I think that's yet to be seen. But at the same time, for the past decade, when central banks have been aggressive in their monetary policy, it's been really good for risk assets. So we feel like being neutral, equity risk now is appropriate. And we went ahead and made that change about a week and a half ago. So to build on the Fed, what you can see in the chart to the left here, you have Fed, Bank of Japan, European Central Bank, Bank of England, showing basically the flow of bond purchases onto their balance sheets. And then that orange line shows kind of the total between all of them. So when that line is going downwards, that means that the pace of bond purchases is slowing. When it's increasing, that pace is going up. So that vertical dotted line there shows kind of a present day situation. So it's right at the point where central bank bond purchases are about to go below the zero line. So basically a tightening, so to speak. But now, since you've gotten a pivot in all of these banks' policy decisions, you're seeing that orange line forecasted to start to move back up and increase. So we think that will be a global tailwind, so to speak, for markets to have the potential to continue to run higher. Moving on to where rates are. So since the sell-off that began in October, Treasury rates have moved down pretty significantly. So the 10-year went from about 325 to where it is today, which is right around 250. And then the 2-year went from almost 3% down to about 2.3. So while the market has recovered, the bond market has been a little less ebullient, so to speak. And the bond market is usually a pretty smart investor, more patient money, not particularly influenced by a lot of the day-to-day headlines in the market, so to speak. But we think part of that lack of recovery in rates is the new realization that the Fed has backed off the story of raising rates. And I know we continue to go over that, but it's such an important aspect of our positioning right now. And also the forecast for slower growth domestically just don't leave a lot of room for rates to move back up. So it was nice to be able to invest in some shorter term treasuries and some safer investments and get some increase in yield. But as those have moved back down, we've lost a little bit of yield potential, though nothing like we saw back in 2017 and 2016, where rates for short-term investments were down close to 1%. The red line there shows what we would call the yield curve or the yield spread, so to speak, the difference between these two. And that has continued to narrow significantly since the start of 2017. Now, why is that important? As we look at the next slide, and we talked in the executive summary about yield curve inversions, this chart shows every yield curve inversion since 1962, with the red dot indicating inversions that did not lead to recessions, and the green dots indicating inversions that did lead to recession. So you can see that there's a lot more green dots on here than there are red. So yield curve inversion is a pretty accurate measure of upcoming recessions. Now, what you will also notice on this chart is the time to recession varies, but the average is about 14 months. So almost a year and 2 months after the inversion, you start to see a recessionary environment. So it's not one of those things where it happens and then the next day everything falls apart. There's some time in between then where markets continue to kind of move along, so to speak. And when we talk about return potential between those, this chart shows kind of some surprising numbers. So what you'll see is this goes back to 1978, a little bit different number, so to speak, because they're using the two-year 10-year inversion as opposed to the 3-month 10-year. So you get an average time frame to recession of almost 2 years. But what I would draw your attention to on this chart is that the price return from inversion to recession is still pretty good, on average almost 12.7%. Now, we're not suggesting that we're going to see a 12% run in the market and then run into recession. Is it a possibility? Sure, it is. But what we are saying is just because there's an inversion doesn't mean that equities can't still run a little bit higher in the interim here before we may run into some issues down the road. So that's our second quarter update right now. Again, we've made the decision to move our equity risk back up to neutral. We feel that central banks have pivoted their policy in a significant way, and that should, at a minimum, provide somewhat of a floor, so to speak, on the market. Not to say that we can't see another 5 or 7% move lower, but we think that the worst case scenario has been taken off the table, and then we think that the long-term trend of the market can continue to move back up. Now, as we start earnings season, it's going to go a long way into determining where we may move next, but that will be watched closely and certainly something we'll be paying attention to for the time being. So either way, we think central banks have done enough to convince investors that the worst case scenario for the markets has been mitigated. So with that, I want to thank everybody for joining. I hope that you found some value in this presentation. As always, if you have questions, comments, concerns, you can always reach out to myself or for your advisor, and we'll be more than happy to set up a time where we can speak one-on-one. Thanks again for joining us, and have a good day.
How did it go?
I think it went all right. End meeting for all, is that?
Yep.